Every booming economy hides one dangerous secret. Money often appears before real wealth actually exists everywhere. That invisible force is credit, quietly shaping businesses, families, governments, and the future without asking permission first. Most people think economic growth begins with hard work, innovation, or factories producing valuable goods every day. Surprisingly, growth often begins with a signature, a promise, and borrowed money entering circulation before production starts. Credit feels harmless because it arrives as opportunity, not danger, masking risks beneath attractive financial possibilities today. Every mortgage, business loan, credit card, and government bond becomes another thread connecting tomorrow with today's decisions. Those invisible threads eventually create powerful economic engines or devastating financial collapses, depending upon trust and discipline combined. Understanding this relationship changes how you see recessions, booms, inflation, and financial headlines forever after today. Imagine opening a bakery without enough savings to buy ovens, flour, equipment, or even rent initially. Without credit, your dream remains imagination, despite having talent, recipes, determination, and willing customers waiting outside patiently. A bank approves your loan because it believes tomorrow's profits will repay today's borrowed money with interest successfully. Suddenly, ovens arrive, employees get hired, suppliers receive orders, and customers enjoy fresh bread every single morning. Nothing magical happened, except confidence transformed future earnings into spending power available immediately through credit creation. That simple process repeats millions of times across economies every year, quietly driving national economic expansion forward. Businesses borrow for factories, trucks, technology, research, inventories, and salaries before earning their first future revenues successfully. Families borrow for homes, education, medical emergencies, transportation, and sometimes simply surviving unexpected financial hardships together. Governments borrow funding roads, hospitals, bridges, schools, defense, and infrastructure, expecting future taxpayers eventually cover repayment obligations. Credit becomes the bridge connecting future productivity with present economic activity, accelerating development beyond existing cash reserves. Without borrowing, economies grow slower because spending depends only upon previously accumulated savings already available domestically today. Credit expands purchasing power, encouraging businesses to invest earlier instead of waiting decades accumulating sufficient internal capital consistently. Faster investment usually means faster innovation, higher productivity, greater employment, and rising national incomes over time consistently. That's why economists often celebrate healthy credit expansion, supporting sustainable economic growth under stable financial conditions worldwide. However, every shortcut carries hidden costs, waiting quietly behind impressive statistics and optimistic economic headlines eventually emerging. Credit accelerates growth, but it also accelerates mistakes, speculation, excessive optimism, and dangerous financial overconfidence simultaneously everywhere. Imagine everyone believing property prices can only rise forever without meaningful limits or painful consequences ever occurring simultaneously. Banks happily approve increasingly larger mortgages because rising property values appear protecting every risky loan issued confidently eventually. Buyers rush faster, fearing higher future prices, creating self-reinforcing demand disconnected from underlying economic fundamentals entirely eventually. Builders construct aggressively, investors speculate enthusiastically, and lenders relax standards, chasing profits while ignoring growing systemic vulnerabilities. Credit keeps flowing, making everyone temporarily richer on paper without creating proportional real economic value beneath surfaces. Asset prices climb because borrowing expands demand faster than genuine productivity or income growth realistically supports sustainably. That difference seems invisible during booms because optimism drowns cautious voices warning about unsustainable financial imbalances developing quietly today. Then something changes unexpectedly, perhaps rising interest rates, falling confidence, weaker employment, or slowing consumer demand suddenly. Borrowers struggle making repayments, investors panic, banks tighten lending, and asset prices begin falling rapidly together everywhere. Yesterday's wealth suddenly disappears because much of it depended upon borrowed money continuing indefinitely without interruption or hesitation. Credit doesn't merely disappear, it reverses, shrinking spending, investment, hiring, and confidence across entire economies simultaneously afterwards. That painful reversal explains why financial crises often spread faster than ordinary economic slowdowns across interconnected global markets. The remarkable irony is credit creates prosperity first, then magnifies disappointment when expectations exceed economic reality dramatically later. History repeatedly demonstrates this uncomfortable pattern, despite generations believing modern finance somehow eliminated traditional economic cycles permanently. During prosperous periods, credit feels responsible because incomes comfortably cover repayments without noticeable financial stress affecting households' nycolds. During downturns, identical debt suddenly feels unbearable because shrinking incomes expose previously hidden financial fragility beneath confidence. Debt itself isn't automatically dangerous. Excessive debt relative to income creates genuine long-term economic vulnerability instead. Think about carrying groceries across a bridge built exactly matching expected weight without additional structural safety margins included completely. Everything seems perfectly stable until one unexpected truck crosses simultaneously, overwhelming carefully calculated engineering assumptions completely overnight. Credit works similarly because stability often disappears precisely when confidence begins fading across financial markets unexpectedly together. Banks become cautious, businesses postpone investments, consumers reduce spending, and economic momentum slows dramatically almost overnight everywhere. This process creates credit cycles, alternating between generous lending and painful tightening throughout economic history repeatedly worldwide. Those cycles influence employment opportunities, housing markets, stock prices, entrepreneurship, and government finances more than many realize today. Yet headlines often blame visible events while ignoring invisible changes inside financial lending conditions shaping everything beneath them. Consider two identical companies selling profitable products with loyal customers and experienced management teams operating efficiently nationwide. One easily receives affordable loans, while the other faces expensive financing despite similar business performance and profitability.
Which company expands faster, hires more workers, and captures greater market share over coming years successfully, naturally? Usually, the company accessing cheaper credit outpaces competitors through faster investment rather than superior products alone, consistently. Access to credit quietly determines economic winners long before customers notice meaningful competitive differences developing publicly visible. This hidden advantage explains why financial systems matter beyond banks and stock exchanges appearing distant from ordinary lives publicly. Healthy lending supports entrepreneurship, innovation, infrastructure, productivity, and rising living standards benefiting societies over extended periods collectively. Dysfunctional lending traps capital inside speculation instead of productive investments generating lasting economic prosperity for everyone involved collectively. That's why policymakers constantly monitor lending volumes, interest rates, inflation expectations, and financial stability indicators carefully together. Their challenge resembles adjusting aircraft controls during turbulent weather without clearly seeing clouds ahead or below. Raise interest rates excessively and borrowing collapses before productive investments fully mature into sustainable economic growth opportunities successfully. Keep rates too low too long, and speculative bubbles inflate beyond manageable proportions, threatening financial stability eventually. Finding balance remains extraordinarily difficult because economic data always reflects yesterday rather than tomorrow's unfolding realities completely. Central banks constantly navigate uncertainty while markets instantly react emotionally to every subtle policy announcement released publicly. Investors analyze every sentence, searching hidden meanings affecting trillions of dollars across global financial markets immediately afterwards. Credit, therefore, depends not only upon mathematics but also expectations, psychology, trust, and collective human behavior continuously. Confidence becomes economic fuel, invisible yet powerful enough, transforming financial conditions almost overnight during critical turning points. Lose confidence, and perfectly healthy businesses suddenly struggle accessing affordable financing despite unchanged underlying operations and customers unchanged otherwise. Gain confidence, and risky ventures attract abundant capital before proving genuine economic value or profitability successfully ever. Human optimism, therefore, amplifies credit expansion beyond objective financial calculations during prosperous economic periods repeatedly throughout history. Fear amplifies contractions equally powerfully, making recoveries slower than previous expansions despite improving economic fundamentals returning gradually. This emotional cycle explains why markets rarely move smoothly, despite sophisticated financial models predicting rational behavior consistently, always. Credit connects millions of personal decisions into one enormous economic network, influencing everyone indirectly each single day. One family's mortgages supports construction jobs, furniture sales, appliance manufacturers, insurers, and countless additional industries simultaneously nationwide. One business loan finances equipment purchases, benefiting suppliers, transport companies, software firms, and skilled employees alike immediately. Credit multiplies economic activity because every borrowed dollar circulates through countless transactions before disappearing from circulation completely. Economists call this multiplier effect, although everyday life simply experiences expanding opportunities or shrinking possibilities instead, naturally. Yet multipliers work negatively too when lending contracts, reducing countless interconnected economic activities across entire regions simultaneously together. Suddenly, layoffs increase, spending weakens, businesses postpone expansion, and governments collect less tax revenue overall nationwide thereafter. Small financial disruptions gradually evolve into broader economic problems through interconnected credit relationships rarely noticed immediately by citizens. That's why banking crises often become national crises, despite beginning inside relatively specialized financial institutions unexpectedly at first. Credit links balance sheets together, allowing confidence and panic spreading faster than physical goods ever possibly could. Technology accelerated this relationship, enabling capital crossing continents within seconds, responding instantly to changing financial expectations everywhere globally. Modern economies therefore depend upon trust, operating continuously across digital networks connecting borrowers, lenders, and investors together seamlessly. Break that trust and economic machinery slows, despite factories, workers, and resources remaining physically available exactly unchanged externally. Restore trust carefully, and lending gradually resumes, restarting investment, employment, production, and consumer confidence together once again. This recovery rarely feels dramatic because rebuilding confidence happens slower than losing it during financial uncertainty periods.
Politicians often promise instant economic solutions, yet credit systems rarely respond according to campaign speeches or slogans alone. Financial reality usually ignores political optimism, rewarding sustainable fundamentals instead of attractive public narratives over extended periods over time. That disconnect frustrates voters expecting immediate improvements following ambitious economic promises from newly elected leaders frequently everywhere. Meanwhile, businesses quietly evaluate borrowing costs before expanding, regardless of political celebrations dominating television headlines each evening. Credit ultimately follows incentives, probabilities, repayment capacity, and confidence more faithfully than public opinion or ideology alone. Understanding this changes how every recession, housing boom, or market rally suddenly appears connected beneath surface events together. Economic growth isn't merely producing more goods, it's carefully managing promises about tomorrow's uncertain financial possibilities responsibly, always. Every loan represents optimism, betting future productivity exceeds today's borrowing costs enough, rewarding everyone involved fairly eventually. Sometimes that optimism proves brilliantly correct, transforming struggling societies into prosperous economic powerhouses within generations remarkably fast. Sometimes optimism outruns reality, leaving painful debts exceeding genuine productive capacity, supporting repayment obligations sustainably anymore afterwards. The difference often appears obvious only after bubbles burst and confidence quietly disappears from financial markets completely overnight. Credit, therefore, behaves like fire, extraordinarily useful when controlled, yet devastating when spreading beyond intended boundaries unexpectedly everywhere. Every generation believes its financial system mastered risk, until history quietly reminds everyone otherwise once again, inevitably. The hidden relationship between credit and growth remains humanity's greatest economic accelerator and most dangerous financial vulnerability simultaneously. So the real question isn't whether economies need credit, but whether confidence can ever remain permanently justified forever.